That's the first tick on the index, down about 60 odd points.
Benchmark indices are down 0.8%. This is the third consecutive day that the markets have declined for us.
The markets are under a lot of pressure, with the Nifty, which is declining 160 points. There is Bank Nifty, which is the one which is putting some pressure.
Got very, very close, within 1% of all-time highs, hesitation, indecision, and finally some profit booking, some pullbacks is what we're seeing. 145 points, 150 points lower on the Nifty, 18,159. So the market did break through Friday's lows, and I think the next level is the 20-day, which comes in at about 18,070 or so.
Okay, third day of a fall in the market. Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track 6 hours of the day's trading action in 5 headlines. I'm Sonia Shenoy, and here are all the headlines for the day. The stock markets fall for the third straight session. The Sensex falls over 500 points and the Nifty loses nearly 150 points. Broader markets outperform the benchmark indices. And the industry gives a thumbs up to the government's decision to scrap export duty on iron ore and several steel products. Minister Jyotiraditya Scindia says that removal of export duty will lead to a new era of growth for the steel industry. And Aarti Industries' 20-year, near 8,000 crore supply pact with Deepak Fertilizers results in a win-win, while RHI Magnesita's proposed acquisition of Dalmia Group's refractories business lifts the stock. And weak demand outlook for China, a healthy stock position in Europe, and slowing US growth drags oil prices lower, even as expectations of an output cut at OPEC's meet on December 4th rises. In stocks and news, HUL gains after positive outlook from its analyst meet and brokerage upgrades. Zomato falls after its co-founder resigns. Escort zooms ahead on the positive growth outlook. And here's the lineup of what we have in store for you. It's a packed show today. In Market Opinion, we have Andrew Holland, the Chief Executive Officer of Avendus Alternate Strategies. In Corporate Voices, we have TV Narendran, the MD and CEO of Tata Steel, with a comment on steel consumption and government's infrastructure push. Well, straight to the day's market action then. The Lal Street saw red for the third straight session amidst growth concerns. The Nifty and the Sensex fell close to 1%, with the Nifty ending below the 18,200 mark. Broader markets fared better but ended mildly lower. In fact, all in all, you'd have to say the market was under pressure because of global cues, and we're still short of that all-time highs, with the Nifty seeing resistance at the 18,400 mark. Prashant Nair is here with a wrap of the day's trading action. Prashant.
The market did come off today. It was looking like it will for the last many sessions, and today we lost about 0.8% in the Nifty. The banks did better, and largely because of PSU banks, and I'll come to that in a bit. Large losses in IT services, real estate, and energy as a pack. Energy, of course, because oil prices have come off. The exceptions, as I said, were PSU banks, which were up. I'll come to names in a bit. And you also had small caps. Although broader market breadth was negative, small caps did better. ONGC was a top loser with, of course, direct correlation with what's happening with oil prices, which are going down. Adani Ports, Hindalco, TCS, etc. A few other heavyweights which were down. Only 3 names with gains in excess of 1% in the Nifty: BPCL, Bharti and Axis Bank. There were 2 listings, interesting price action. One opened sharply lower but ended higher. Both actually by close were higher in trade. One a chemical company, the other an NBFC. Broader market cuts coming through in Zomato and Nykaa, which continue to go down. Defense names are seeing pullback, so Mazgaon and Kochi Shipyard both lower. Adani Green, Lodha and Kim's Hospital chain were some of the other cuts today. Gains coming through in Escorts. The company held an analyst day. Markets liked what they heard. IEX, Godavari Power, UCO Bank Central and IOB from the PSU bank space doing pretty well. Are we starting to see some pullbacks in global risk-on moves as well? And I think that's the relevant question here. For the Nifty, the 20-day, which is about 60-70 points away from where we closed yesterday, becomes important, a level which bulls must defend if buying has to come back in the near future once again.
Okay, so that's on the market and how it fared at close. Remember, 18,400 has become a bit of a hurdle for the market. So we're just short of those all-time highs because of the global cues and the kind of pressure that we're seeing over there. In that context, in fact, we have some commentary coming in from Andrew Holland, the CEO at Avendus Alternate Strategies, who said that emerging markets will be the place to find growth going forward. He also discussed his sectoral bets in the Indian markets. Listen in.
Emerging markets will be the the place to find growth and a pickup in the global economy. Obviously not initially, but that's how the market will play it. But in that, interestingly, whilst everyone's talking about emerging markets, I think the overweights are going to be more of the exporting type countries like Korea, China, which is obviously, we've seen some kind of pickup there from the very low levels. And I still like the banking sector and the auto sector. I mean, they might have those kind of pullbacks, but those are the times when you should be buying into it. But I think the themes could continue to remain defense, renewables, and then the kind of corporate capex cycle into those, those industries where the supply chain has been difficult going forward. So semiconductors is one, electronics will be the other. So these are the new kind of themes which I think will play out in 2023. So the valuations, some of these sectors still remain high, but I think you have to be very selective on, who's going to be the beneficiary. We talked about this before, like if it's a capex cycle, it's
All right, that's the word coming in from Andrew Holland. But we also had a chance to speak to Mark Matthews of Bank Julius Baer and Company, who continues to remain overweight on the Indian markets. He said that India will be insulated if there is a recession in the US. So he was quite optimistic despite the global challenges. Take a look.
We are already overweight India. We've been so for well over a year, and we would like to remain so. The chances of a recession in America are high next year. We put the chance at about 40% right now of a recession happening in America. But I suppose that the markets have already priced that in because, as I said, they have underperformed so much this year. Anyway, on balance, we still stick with India because it's not a proxy for the global economy. It's a proxy for its own economy. And its own economy is doing well, and we think it will continue to for a few more years. So despite the fact that it's expensive relative to the others, we're very happy keeping our overweight there. I think it would be quite well insulated, and the reason I say that is there's two things. The first is that foreign investors, as you would know, have not built up substantial overweight positions in India. Quite the converse, actually. And so that's a big difference between today and 2008. 2008, India, of course, went down a lot. But that's because foreigners had been buying it up for the last few years. And the second thing is, unlike 2008, if we do have a recession in the United States next year, I think it'll be a very shallow one.
Okay, on to the second headline now. CNBC-TV18's news break is now confirmed. The government has withdrawn export duties on most steel and iron ore products that were levied in May this year. The Steel Ministry says that the rollback decision was taken on the back of a steep fall in steel exports in October. Nigel is here with more on that. Nigel.
Well, that's right. The export duties that were levied in May 2022, they have been rolled back. So on steel, stainless steel, pellets, as well as iron ore with Fe content of less than 58%, it's been brought down to zero. On iron ore with Fe content of more than 58%, it's been brought down from around 50% to around 30%. And they've reintroduced the import duty on coking coal. Why did they do this? Why is the reason for the pullback? Well, the key reason was to bring down prices, and that's been achieved, partly achieved. The second factor is demand has been dwindling because there's no export a window that's open to some of these producers. So demand has been dwindling, inventories have been going up as well, and some point of time it may cause them to pull back their capex that they have already laid out. And finally, the trade deficit number has been a little on the higher side. So maybe this provides some bit of a cushion. Focusing on individual stocks and sectors, well, for steel companies itself, the key beneficiary of these would be JSPL, JSW Steel, Tata Steel, as well as SAIL. How do they benefit? Well, they can re-export if they need to. However, on the pricing front, it doesn't provide them any kind of cushion because domestic prices are at a premium in comparison to international prices. Moving to the stainless steel players, well, they gain. Europe, as it is grappling with the energy crisis, so they have an opportunity to export, and they can restart that with the removal of this export duty. Remember, for JSL Stainless, well, they were exporting close to 25 to 30% of their volumes, which came down to around 5%. Pellet producers, particularly Godavari Power and Ispat, they were exporting close to 70% of their total production. They can restart that. And finally, NMDC, though they don't export iron ore, but with pellet prices moving up, it'll give a bit of a base or some bit of a fillip to iron ore prices as well. What are brokerages making of it? Well, Jefferies, they say that this is unlikely to provide any support to the steel prices. So they have their neutral rating, a hold rating on Tata Steel, as well as an underweight rating on JSW Steel. Phillip Capital, they say that this is a positive, but from the medium to the long term. In the near term, it's not much of a catalyst. And ICICI Securities as well, they perceive the rollback of export duties as a valuation re-rating event, not an earnings upgrade trigger. So put all this together, that was the big news today.
All right, that's on the steel sector. The industry, meanwhile, has given a thumbs up to the government's decision to scrap export duty on steel and iron ore. Danish Anand gets us the feedback from the steel industry.
As the economy is bouncing back from the pain imposed by COVID, the government last week gave a major relief to the steel sector by removing export duty on certain items. Well, this had been a long-standing demand of the industry, and the government feels that this will lead to a new era for India's steel sector. Well, this is what the major industrialists from the steel sector had to say.
We expect this demand and requirement to continue, but is there any concerns for the future? Yes, it's absolute yes. We have to be vigilant about the changing expectations from the steel industry as the country marches forward in the infrastructural growth.
Winter time generally for European countries, US countries, export market, if I can say, is generally at a slowdown pace because they're looking at destocking mode. But we feel after January onwards again the export market should pick up.
So very lastly, what are your expectations from the upcoming budget? Is there a particular wish list that you have in mind?
So one thing was definitely the removal of export duty. The other request would be that any kind of dumping that is happening in the country which relates to steel, stainless steel, that should again be looked at by the government in a favorable manner and take some action according to that.
I would say over the last 6 months, demand in steel in India has held up actually the steel industry, while exports was not there. The international demand has been impacted, one because of the pandemic, followed by the war, and the high energy cost as a consequence of the pandemic and the war is resulting into some de-acceleration in the demand in many parts of the world. But we expect that to be sorted out probably as we go along into the next year.
While the industry is happy with the latest government announcement, but still there are many challenges in the future as currently the international demand is low and it is majorly the domestic demand which is keeping the steel industry running. The industry expects certain announcements from the government in the upcoming union budget, and the industry feels that there should be some announcement on anti-dumping of stainless steel, there should be some announcement on demand generation, and they are seeking a clarity on green steel, decarbonization, and how the government will help the industry in energy transition. With video journalist Rajinder Singh Raina, this is Danish Anand for CNBC-TV18.
Okay, that's on the steel sector. But let's move on to the third headline today. Aarti Industries and Deepak Fertilizers were up by over 2% and 7% in trade today. This after Aarti Industries, the largest consumer of nitric acid in India, and Deepak Fertilizers, the largest producer of nitric acid in Southeast Asia, signed a 20-year agreement for the supply of nitric acid. Now, what does this mean for both companies? Sonal Bhutra is here with the details. Sonal, over to you.
Yes, Aarti Industries is in focus, so is Deepak Fertilizers. Both these companies have entered into a 20-year binding agreement, and this is for Deepak Fertilizers to supply nitric acid to Aarti Industries. In terms of more details about this, this term sheet is to be executed by end of calendar year 2022, and the total cost here, or the total size of the contract, is around 8,000 crore rupees. Now, to give you some perspective, Aarti Industries is one of the biggest users of nitric acid, and for Deepak Fertilizers, it is one of their biggest product as well. They already had an agreement in place which is getting expired on 1st of April, and that's why the renewal of that contract, but tenure this time is much longer, close to 20 years versus 3 to 4 years earlier. Aarti Industries was already planning to set up a nitric acid plant in order to ensure that there is backward integration and secure their raw material supplies as well, but now they won't be going ahead with it. And they did mention how availability of nitric acid will continue to become a big issue for the company, and now they have secured this. So that is really the impact. The agreement secures supply of nitric acid, which is a big raw material for the company. We spoke to the company earlier in the morning, and they did mention that they now will not be putting up that nitric acid plant that they had earlier planned. The investment in the nitric acid plant was expected between 150 to 200 crore rupees. The overall cost could be around 800 to 1000 crore rupees. But now that they're not going ahead with it, it will free up the capital for Aarti Industries, and that of course is a big positive. And this contract, according to the company, will also enable volume stability and pricing comfort as well. And that's why they are quite positive on this particular contract that they have entered into with Deepak Fertilizers.
In view of overall growing nitric acid demand, we had to put our own plant. We had already announced putting up a concentration plant in the month of April. We are just evaluating whether we put our own WNA plant. That's where this long-term contract discussion started. We will not be putting up that plant now once we have this contract in place.
Okay, they're not planning to set up a plant right now because the contract is in place. Meanwhile, RHI Magnesita surged by over 10% in trade today after it acquired 100% stake in Dalmia Bharat Refractories. The company's management told CNBC-TV18 post the acquisition that debt will be at 1,300 crore rupees and it has plans to spend 200 crore rupees of capex. Listen in.
Around 100 crores, and with this debt it will be around 1,300 crores, but still I believe it will not have a serious impact on my debt. That equity ratio will still remain 1:1 or so. Kept 200 crores roughly for modernization of Dalmia Bharat Refractory, but it will be spent in next 4 or 5 years' time.
Okay, let's take a quick commercial break on that note, but do stay tuned in. We'll be back in just moments from now with all the other top headlines of the day. Stay with us.